there's somewhat of a push and pull there. So when we look at the role of technology deflation, for example, there's certain advancements in technology can make some areas cheaper, right? So TVs get cheaper, computers get cheaper, manufactured goods get cheaper. Now, AI can make certain white collar work cheaper because you're offloading some of that to a processor. Now you're competing with that on price, and so that can be disinflationary in certain categories, whereas other categories remain unaffected.
Hey guys, welcome back to Everyday Finance. According to Lyn Alden, Lyn don't anticipate a significant bullish cycle coming up, but rather a flat to upward trend in the overall market with various opportunities. More potential for gains than losses well. As that unfolds, she believes inflation will be comparable It seems that Lyn Alden not anticipating significant inflation by this time next year, but she do believe that the baseline level of inflation is expected to stay higher than the average of the previous decade, reaching higher levels. With higher lows and an overall upward trend, it seems like there are potential opportunities for gains in the market. Certainly, specific geopolitical events or disruptions could lead to significant shifts to the upside. Energy prices, overall inflation measures, or both, and lots of things Lyn Alden discussed. So please watch the video to end. And share this video and subscribe our channel Everyday Finance. Thanks.
And to kind of clarify the energy point, it's not necessarily that I expect, for example, a huge bullish cycle right ahead. It's that I expect that the overall market is flat to up, and that there's more kind of risk to the upside than the downside. And so as that plays out, I think inflation is going to be similar in the sense that, I'm not expecting necessarily massive inflation by the next year, but I do think that the average baseline level of inflation is going to remain higher than it was last decade on average, basically higher highs and higher lows, and that overall that the trend is basically at least mild surprises to the upside, and that of course certain geopolitical events or certain disruptions could cause major dislocations to the upside, either in energy prices or overall kind of inflation measures or both. And I think that there's somewhat of a push and pull there. So when we look at the role of technology deflation, for example, there's certain advancements in technology can make some areas cheaper, right? So TVs get cheaper, computers get cheaper, manufactured goods get cheaper. Now, AI can make certain white collar work cheaper because you're offloading some of that to a processor. Now you're competing with that on price, and so that can be disinflationary in certain categories, whereas other categories remain unaffected. And so I think that the energy side is going to be one of those at least relatively unaffected categories by some of those, rapid tech increases in the next, call it 5+ years. And so I think you could see bigger than normal gaps between different categories. Over the past decade, for example, things like healthcare, education, housing, all of that was inflating at a really rapid pace, where it was being offset in the CPI by electronics, manufactured goods, textiles, things like that. And I think if you could kind of run that over the next decade, I think you could see white collar labor, certain services, certain things like that be a little bit more disinflationary, whereas things like energy could be more significant contributors and kind of real world stuff. That kind of ties in also to reshoring some manufacturing, which is a very long and expensive process, and adds generally to prices. The world that we had over the past 30 years was one of rapid globalization. So, China reconnected with the rest of the world. All that Eastern labor connected to Western capital markets, and kind of that was a very disinflationary force and way more productive. Russia, the Soviet Union fell and opened up and connected to the rest of the world. They, their energy and materials connected to Europe. That was all kind of these separate systems coming together, which is disinflationary and generally productive, but it came at the cost of resilience. Everything's kind of all connected together globally, and so it only takes fairly modest geopolitical issues between, former enemies, and that gets thrown out the window. And so I think that we don't have that 30-year trend in front of us anymore. I think best case scenario would just kind of stay somewhat isolated. Worst case scenario, there's obviously more disruptions ahead. And so these are all kind of background inflationary forces And then it just becomes a matter of how large are those relative to certain pockets of disinflation, like AI on white-collar wages and things like that.
According to Lyn Alden, deficits can contribute to inflation, but there are also other factors at play. Lyn prefers using the 1940s as a reference point because inflation is commonly associated with the 1970s. There are similarities to the 1970s, such as the potential for energy disruptions, but overall, there are two primary sources of income. Generating economic growth in a fractional reserve economy can stem from banks. When lending occurs, a fraction of the reserve bank lending creates more deposits in the system, which are then utilized for various purposes, considering additional loans or increasing monetized fiscal deficits. Oh, and you possess the ability to partially facilitate government spending and inject funds as needed. Injecting funds into the system led to most new money being generated through loans in the 1970s, largely due to the baby boomer generation. Boomers were entering their home buying years for a significant 20-year stretch, and that was a period of due to the accelerated increase in credit. And then they encountered energy limitations. So looking at both perspectives, in the 1940s, there was a comparable average inflation rate for the decade. Yet banks were hardly affected, not focusing on lending at all, but rather on the fact that most of the new money creation was a result of very large fiscal deficits engaged in the battle of developing manufacturing processes, even after the soldiers returned home and were trained. College, technical schools, mortgage assistance, and all those aspects cover both domestic and international matters. The fiscal stimulus is being monetized, leading to an increase in the money supply circulating outside the banking sector. Let's back to the Lyn Alden interview.
Yeah, so overall, the debts and deficits are net inflationary, but again, there's other forces. The description I like to use is the 1940s, because when people think of inflation, they often think of the 70s. And there are some parallels to the 70s, including, for example, risk of energy disruptions. But there's two major sources of money creation in an economy, in a fractional reserve economy. Either it's from bank lending, so fractional reserve bank lending, lending creates more deposits in the system, which then get used for more lending, or you run monetized fiscal deficits, and you have the kind of the central bank kind of partially facilitating the spending of the government, and that kind of injects money into the system. And so in the 1970s, the bulk of new money creation was from lending. And it was because the baby boomers were entering their home buying years for like a 10, 15, 20-year stretch there. And that was a period of just more rapid credit growth because of that. And then they ran into, of course, energy constraints. So you had both sides of the coin. In the 1940s, you had a similar level of average inflation for the decade, but banks were barely lending at all. Instead, most of the new money creation was coming from very large fiscal deficits involved in the war, involved in building out manufacturing, involved in, even when the GIs came home, putting them through like college and technical schools and mortgage assistance and all that. That's all basically domestic and foreign kind of fiscal stimulus is getting monetized, increasing the overall money in the system and going around the banking sector. Or in many cases, the banking sector is forced to purchase a lot of those bonds to finance it. And so far in the 2020s, we're closer to the 1940s scenario, which is that our higher than normal period of money supply growth and our higher than normal inflation levels were not because of excessive bank lending. They were because of very large monetized fiscal deficits. The second point there is that when you look at the 70s, how do they slow down inflation? They got much tighter monetary policy. They raised rates, and that's effective because mostly what the Fed does is target the bank lending sector. So by increasing interest rates, they slow down the rate of bank lending, slow down the desire to borrow. And it does have the effect of increasing fiscal deficits because it increases the interest expense that the government pays. But back then, public debt was 30% of GDP, and most of the money supply was growing from the lending sector. So if you jack interest rates up to double digits, it is disinflationary. The problem is when you have a scenario like the 1940s or like a scenario today, where you have 120% debt to GDP, when you raise interest rates, it does mildly slow down the bank lending, but that's not where the most money creation is coming from. Instead, it's coming from the deficit, and higher rates make the deficit even bigger. And so monetary policy tools are generally less effective at dealing with fiscal-driven inflation. And so overall, my base expectation for the next 5, 10, 15 years is continued very large deficits. Should those deficits result in liquidity problems in the treasury market or adjacent markets, the Federal Reserve is practically forced to come in and assist with those with liquidity injections, basically balance sheet expansion. And all of that is a net positive liquidity inflationary force that's more kind of industrial policy, more like the 1940s. And so when I kind of look forward, it's less that I see a depression in kind of the 1930 sense, and it's more like I see industrial policy in a similar way that the 1940s were. But it's a very different environment because you have older demographics. The spending is probably not getting as targeted as things back then. So back then, it went to highways, it went to energy production, it went to manufacturing. Whereas now, a lot of these fiscal deficits are actually fueling consumption, but not really facilitating the production to meet that consumption. And so, on average, I would expect, higher baseline inflation minus whatever we get from that AI component.
According to Lyn Alden, when examining the 1970s, their approach to curbing inflation involved implementing a significantly tighter monetary policy, which increased the rates. And that's effective because the main focus of the Fed is to target the bank lending sector. When interest rates rise, they can have an impact on bank lending and borrowing behavior, impact of rising fiscal deficits on the government's interest expenses in the past. Public debt stood at 30% of GDP, and the money supply was mostly increasing. Coming from the lending sector, increasing interest rates to double digits can have a disinflationary impact. The issue arises when imagine a scenario similar to the 1940s or the current situation where the debt to GDP ratio is at 120% and interest rates are raised. Interest rates have a slight impact on bank lending, but that's not the main factor. Money creation is not coming from where it should be. Instead, it is stemming from the deficit. Higher rates only serve to exacerbate the deficit further. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.